Hi everyone. So today we're going to be looking at foreign currency transactions and how to account for these in line with the IFRS standards or the IAS standards. Now, firstly we have to understand what is meant by a monetary item, what is meant by a monetary asset and a liability. So think of money. Basically, a monetary asset or liability represents the right to pay if it's a liability or receive if it's an asset a fixed amount of money. So examples of those are trade receivables, where you have the right to receive money from your customers, and trade payables, where you have the obligation to pay monies to your suppliers, a fixed amount of money. Okay, what aren't monetary items? Well, PPE, inventory are not monetary items. Okay, so those are not monetary items, and the accounting for these is different when it comes to foreign exchange. Now, let's look at an FX transaction. So on the 1st of January 22, I feel quite happy, so I purchased some inventory for 10,000 euros on credit. I want to know how to account for this. Well, we have to know the exchange rate at that given date. So at that date, the rate was 1.19 euros to the pound. So 10,000 euros gives us 8,400 pounds. So how do we account for this? Well, we're making a purchase of inventory, so we debit purchases, and because it's on credit, we haven't paid any cash, we credit trade payables, 8,400. Seems simple, right? Well, the year end comes around, and the exchange rate's moved, but the 10,000 euros is still outstanding. How much money do we actually owe in pounds? Well, that's going to be given by the 10,000 euros divided by 1.23, and that's going to give us 8,100 pounds. What does this mean? Well, it means that we owe 300 pound less. So our trade payables has gone down by 300 pounds. What are the double entries? Well, as we said, the trade payables has gone down, so we debit trade payables 300, and we put the credit to an account called foreign exchange gain, because we've made a bit of a profit because our trade payables has gone down, our liability has gone down, but we haven't paid anything. So we do debit trade payables, credit foreign exchange gain, £300, and that means our profit is higher by £300, and our CEO gets very happy with us. Okay, so this foreign exchange gain is a P&L account. Now let's think of another situation, the opposite situation. So I'm selling some inventory for 10,000 euros on credit instead at the same date. How do I account for this in pounds? Well, again, we know that 10,000 euros is about 8,400 pounds at that date. So we do, this time, we're making money, so we credit revenue 8,400, and the debit goes to trade receivables, 8,400. We hope to receive that amount of money in the future. But hang on, what happens? Well, at the year end, the exchange rate moves. It moves from 1.19 to 1.23, but the 10,000 euros is still outstanding. How much money are we owed in pounds? Well, let's see. 10,000 divided by 1.23 gives us 8,100. We're owed £300 less. Not happy, not good, my friend. What are the double entries this time? Okay, so we're not owed the same amount of money, unfortunately. We're going to have less cash flow coming into the business. Well, so we credit trade receivables 300 because the amount of money we're owed has gone down, and the debit goes to a P&L account called foreign exchange loss, £300. So our profit is lower by £300. Okay, so I just want to emphasize this is not a cash flow movement. This is just an accounting movement. Okay, so we've seen a foreign exchange gain and a foreign exchange loss. A gain when the asset has increased in value, and a loss when the liability has gone down in value, and a loss when the asset has gone down in value. Okay, so we have to understand how to account for monetary and non-monetary assets. Let's do non-monetary first. So non-monetary assets and liabilities are translated at the historical rate. Okay, so what does this mean? Well, it means, say if I buy land for 10,000 euros on the 1st of Jan 21, this translates to 8,400 pounds. So how do I account for this? Well, I do debit Well, and don't worry about the double entries, but basically that land is recorded at 8,400, and basically at the 31st of December 21, it means that we're still going to record that land at 8,400, so there's no movement at all. There's no movement to profit and loss. Okay, so there's no foreign exchange gain or loss. But monetary is a bit different, and we saw that in the previous examples. So how you account for monetary assets and liabilities is you keep translating them at the current rate of exchange. So when it comes to the year end, we have to translate them at the year end exchange rate. Okay, and then based on the and then obviously because of that translation, we have a movement that will in the asset of or the liability that's going to hit our profit and loss statement. Okay. So that's the difference basically. Non-monetary has less work to do. Monetary you have to retranslate at the year-end rate. Now let's look at an exam situation. A common question that might occur in the exam. So I have a trade receivable balance of 10,000 euros at 1st of Jan 22. That corresponds to 8,400 pounds. I received 2,400 euros on the 1st of June 22. When the exchange rate is 1.2 euros per pound, right? No further monies are received, and the exchange rate at the 31st of December 22 is £1, 1.9 euros per pound. Calculate the foreign exchange movement. Now, for these kinds of situations, I recommend you use a table. So you have four columns. First column is euros, then you have the exchange rate, then you have GBP. And then along the bottom you have the dates, the key dates. So the first date is when the sale actually happened. Second date is when you receive some money, and then the third is the year-end date. So first thing we do is we know 10,000 euros has the same value as 8,400 pounds. Fine. We then take away the 2,400 euros and translate it at that given date. So the 1.2 we put here, 2,400 divided by 1.2 gives us 2,000. What do we do next, do you think? Well, we basically do 10,000 minus 2,400, and on this side we do 8,400 minus 2,000. So it gives us this. 7,600, it translates to 6,400. Okay, what's next? Well, at the year-end date, we have to retranslate it. So we put the 7,600, which is still remaining here. We put the 1.9 euros in the exchange rate column, and we retranslate it. That gives us 4,000. Okay, so basically our asset has moved down from 6,400 pounds to 4,000 pounds. So that's the foreign exchange movement. Okay, our foreign exchange movement is a balancing figure telling us how we got from the 6,400 to the 4,000 pounds. So what are the double entries for this? Well, simple. Think about it. Our trade receivable has gone down, so we credit trade receivable 2,400, and the debit goes then to foreign exchange loss, which is a P&L account. Okay? And that's all I wanted to say really, is that a table is really helpful for doing these kinds of questions, and if you play your cards right, you can get all the marks for the calculation. But I do want you in the exam, if possible, specify whether an asset is a monetary asset or a monetary liability or whatever when you're explaining the treatment, and explain that you have to therefore translate it at the year-end rate with the movement being reflected in the profit and loss statement. Okay, that's how you explain it in the exam. That's all I wanted to say, guys. Hopefully it was useful, and look forward to hearing from you. Cheers. Bye.